Hi, Dan Fatica of DJF. I wanted to jump on this morning to explain how our investment model is different and protects our clients against the massive volatility that we're seeing in the stock market. All right, I saw on the Financial Times this morning that markets globally are down about 10-11% this week, and that has huge ramifications for people depending on where they are in their stage of life, and how that affects their lifestyle and their investment portfolio going forward. All right, there is beauty in stock market investing. You definitely get huge waves up, but as we've seen this week, in the last 5 days alone, you also get huge waves down. That's fine early on, but the clients that I'm working with off the back of or investing in equities for 30-40 years, they're looking for something a little bit more stable, and that's where real estate is really coming into its own with my clients. For the last 4 years, I've been working in investing my own money, my family's money, and my clients' money into more stable income producing assets, be it direct investment in real estate or passive investment in real estate, as in not being the developer, but in fact being the lender for other investors' projects. I'm just going to go through how we secure those monies and maybe put the pros of working with real estate versus the pros of stock market investing, and how these two strategies differ. All right, so in the last year alone, the S&P 500, which is the stock market index for the States, one of the main markets, that's grown sort of 30% in 2019. But in this week alone, as we've seen, the last 5 days, markets have come down by about 10 or 11. So what we're getting there is huge growth, but at the same time, big losses as well. Okay, so think of, in a week alone, losing 10% of your portfolio. If you're at a stage in life where you're relying on that income, that's really going to hit you quite hard. All right, DJF, we're delivering returns of 8-10% to our clients every year. The last 2 years that we've been working, we've been delivering an average of just over 9.2%, and that's paid monthly income. It's not compounding, fine, but a lot of our clients are 40, 50, 60 years old plus, and what they're looking for in their lifestyle is a preservation of their wealth and an income to support their lifestyle. Right? They're not trying to grow massively. It's much more of a protection. Don't get me wrong, they're going to have different investment strategies, but this is how we protect their wealth and deliver really great competitive returns. 8-10% looking back over the last 30 years, that's on average the annual return of the stock market. But the pro that we've got through investing this way is that our clients don't suffer from that great up and down. They're not on a roller coaster. It's very predictable. Each month they're getting that check for whatever it be, 400, 800, 2,000 pounds, and that goes towards supporting their lifestyle, as well as protecting this nest egg of 100,000 pounds against a property of material value in a market that doesn't trade as quickly. Okay, property is very liquid, so when you're buying and selling a property, you're looking at least 12 weeks down the line, from an offer being accepted to purchase a property to actually trading and transacting on that. All right, so how we protect our investors: we've got a house that requires a loan. Okay, we send a chartered surveyor out, someone that is employed by banks to value the open market or 90-day value of an asset. In this case, it could be a house, it could be a flat, it could be a plot of land, it could be an office. There's something called a red book, which is the guideline for producing a valuation over these assets, and we have one of those reports commissioned before we lend any money. All right, now let's say that this house is worth £100,000. Right? At DJF, we're going to be lending 75% of the value of that property. Now, it might sound pretty aggressive up front, but let me talk you through the model, so just bear with me. All right, 75%, we're lending on an asset which is distressed, okay? Our clients, they're looking to purchase an asset for their portfolio, and they're investors themselves, all right? So they've got a portfolio behind them of income producing assets, residential properties, maybe offices, but our typical client is a portfolio landlord, so they're going to have buy-to-lets, HMOs in their portfolio, as well as maybe PAYE income, but we don't tend to look at that because that's more living. It's the affordability through the rentals that supports this, all right? So we're lending £75,000 against this house, all right? The typical model is that investors are buying a house in a particular condition, forcing the appreciation by renovating it, okay? So buying a tired, smelly house, renovating it, making it nice, that's a new kitchen, a new bathroom, painting it and decorating it, and we're refinancing on a much higher value after, okay? So for example, this case, if it's bought for £100,000, we're spending £15,000-20,000, it's hoped that the value of the property has at least gone up 120 to 120 after that renovation. Just cosmetic work, there's not a huge development risk here, there's no planning required. It's very, very straightforward. All you need to do is get a good handyman in there or build a project manager, and a lot of these people do it themselves. God, my dad definitely was the handyman around the house when I was growing up. Now, looking at 120, our £75,000 looks pretty competitive. The risk exposure is going down and down and down as money is spent renovating this security, okay? So at 75%, which is the typical mortgage for these buy-to-let investors, we've got a £90,000 mortgage to pay out our £75,000, which means at the end of the project, our £75,000 is going to be lower than, which sign is that? Less than 66% loan to value. Okay, it's very easy to refinance out to 66% loan to value, 63, with mortgage products on the market today. Okay, you can get buy-to-let finance up to 80%. So as a maximum here, we'd be able to release something like £100,000 against that property. So that's how our investors are protected. How they earn their income. I mentioned the portfolio that are behind these investors supporting them. That is what is affording their interest, their return, and our investors are typically earning 8 to 10% on their money. £75,000 in the stock market could go up, down, sideways, but putting it into an illiquid asset like property, that's going to be a store of wealth. There's not going to be huge volatility on it if the market does come down a little. You know, we're spending the best part of £20,000 pushing this property up to top standard. So there's a real case for the value of this loan not eroding. In the event of default, this property can be repossessed and sold for up to a 25% discount, and we still recoup all our monies. Okay, yes, it's a little liquid and you can't get in and out of these investments too quickly, but you know, paying the price for having that liquidity, you're going to be suffering with volatility. Okay, I hope that's clear. I thought it was topical news. You know, this coronavirus is having a massive effect on equity markets globally. I think this is just the tip of the iceberg, and there's going to be a real correction on the last few years of great growth in equities. Don't get me wrong. But you don't want to be the person that's caught swimming naked when the tide goes out.